Welcome, everybody. Thank you so much for joining us for the 10th annual Do It in Durham Entrepreneurship Week. Durham Region celebration of entrepreneurship held each November during Global Entrepreneurship Week. Do It in Durham is a collaboration of Durham's business support, educational, and networking organizations who have come together to encourage and support entrepreneurs, job creators, and innovators like you who create economic growth in Durham region. So if you're looking to start a business, invest in a business, grow a business, hire people for a business, we encourage you to do it in Durham region. This year, we have our own app. So if you haven't yet checked out the app, check it out. It helps you keep your schedule and keep up to date with what's happening. It also gives you the opportunity to connect with attendees. So it's another great way to network, especially because we're still doing a lot of these virtually. It's another way to find out who is in the community and who you might be able to do business or grow your business with. A few meeting notes. BACD is the lead coordinator of Do It in Durham. However, it is very much a community event. And I just really want to do a quick shout out to our sponsors. Our premier sponsors for this year's Do It in Durham is City of Oshawa, the Economic Development Department. You've got BACD, Invest Durham, Ajax Advantage. Our partner sponsors is the town of Whitby, the FedDev of Canada, so they're called the Federal Economic Development Agency for Southern Ontario, KX96, our own local radio station, KX96 FM, I have to be specific. On the community sponsors, we've got Ontario Tech University, Brilliant Catalyst, the City of Pickering, and the Spark Center. So again, we cannot do these things alone. If we want to grow anything, build anything, it really does take community to support each other. Feel free to share your experiences and to help raise awareness about Durham region and about your business. Let the world know, let your local community know you are open for business. I'm going to provide in the chat box some of the hashtags to use to help boost some of those posts and get the word out there. My name is Patrice Esper. For those of you who've never met me before, I'm a business advisor and program coordinator at the BACD. Been here for about 8 years. I can't believe how fast it's flown. I'll be facilitating this session and I will be monitoring the chat box. So if anybody has any questions, I encourage you to put it in the chat box and then I will interrupt Alka at a reasonable time and she's willing to address the questions. If you haven't already, I encourage you to add in the chat box quickly because I don't want it to interrupt when Alka gets started. But please share with us who you are, what you do. Maybe it's a website you want to share with us and where are you joining us from? So far I've seen people from Newcastle, from Pickering, from Mississauga, which is awesome. And also for those of you who've never done this before, in the chat box, you'll notice a little, like it looks like a piece of paper, a smiley face, and then 3 dots. In the paper one, you can save the chat. So if you want to hold on to everybody's information, you can save the chat to your computer. We encourage you to turn on your cameras for a more engaging experience, especially if we open it out to questions and things like that. And at the end of the day, this is all Alka's. So I'm delighted to now hand the session over to Alka Sood, who will be presenting Let's Talk Money. Alka.
Wow, that's quite the intro. Thank you, everybody. I'm really happy to be here. And this is one of my first webinars in my post role as a BDC consultant. So let me tell you a little bit about myself, and then we'll jump right into the content. Earlier, for those of you who have just joined recently, I keep a fairly intuitive, interactive dialogue throughout the presentation that I'm going to make to you. And what I would welcome you to do is to, say, hey, yes, but I have something to say. And I'd welcome you to either put it in the chat or just put yourself off mute and ask me what you'd like to ask, because we've got an hour and a half. I don't have 600 slides to work through. I've very carefully chosen a few select slides to really stimulate discussion. And I don't really want any of you to feel shy about asking or saying anything. The one thing I'd like to ask you to do is keep your financials confidential and to yourself, because that is private. But if you do want to talk to me later, you can always reach out to Patrice later and she can connect you to me if you'd like. Okay, so this is not just a closed door. I do a lot of this kind of work, and often people don't really want to talk about money, but I'm going to make you, and that's why I called it Let's Talk Money Today. So let me tell you a little bit about myself first. So I have been consulting for over 30 years. I came out of MBA school and went with, joined Deloitte Consulting and got raked over the coals trying to be a consultant there. And then I had my own practice for a while. But the most important and stimulating work that I did do was when I worked with the Business Development Bank of Canada. And there I led the financial management practice, and I received the opportunity to work with all kinds of small businesses who are just a touch bigger than you, and some of them are a lot bigger. And so I got to see it all. I got to see the stupid stuff. I got to see the fun stuff. I got to see innovative stuff. And as far as I can tell you, is every entrepreneur I've met has got a funny story to tell me and is an extraordinarily creative person with their finances. So I think I've seen it all. But I say that every morning, and I find something new when I wake up. So be happy to ask questions to me, and I'll share the experiences that I've had. And I want to bring that information to you. I don't like to hold it all in. I'm a very transparent person. So what am I doing now? I have my own consulting practice still, but I'm also a chief financial officer for a health and wellness research and consulting practice. So I don't just talk the talk, I actually do the talk. So I feel the pain, I feel the cash flow pain, I feel the profitability pain, I feel the revenue pain. So been there, done it, and I can empathize with you. So by all means, if there are questions that you want to ask and want to share with me, just stick up your hand or put the note in the chat box, and we'll go from there. And of course, Patrice is going to monitor that side of it, and she's going to interrupt me. I speak quickly. I try not to. If I am saying something that you don't understand and you want me to go back and explain it, please ask me to do so. We don't have, like I said, lots of slides to work through, but heavy concepts to work through. So I'd like to be able to do it slowly. I'd like to go through it gradually and then get as much as we can done. This deck is available to you after the presentation. So often what I see when we do these, people are taking their camera and taking a photo of every single page. You don't need to worry about that. It's on its way as soon as you get off the call. Okay, just listen to the conversation, lean in, and ask me whatever you'd like. I can't emphasize that enough. So what am I really going to talk about today? I'm really going to talk about 10 ways to manage your finances better. And these 10 ways have really come to me that, after seeing close to 1,000 small entrepreneurs across the country, from Atlantic Canada all the way out to BC, who have had financial management challenges. And these are the 10 themes that come up, whether you're a $100,000 business at the top line, whether you're a $55 million business at the top line. The same things happen over and over again. And the number of companies that don't just apply these rudimentary techniques are huge. So I always keep coming back and going back to the basics every single time with them. So don't feel embarrassed that if you're not doing it. Everybody is in the same boat as you are. So the one thing I want to talk to you about is money. And often people don't like to talk about money. It's embarrassing. I don't have enough. I don't make enough money as all people. Money is a shameful product. We shouldn't be talking about money. It makes us greedy. It makes us feel like we're bad people talking about money. But at the end of the day, for a small business, money matters. And I'd like to change your mindset from this, that you need to be rich to start a business. You don't. You just need to be creative, innovative, and smart with your money. Money will solve my business problems. So That's the first mistake. A lot of my entrepreneurs that have come across me have said, well, I just need a loan and I'll get past this. The answer is usually much deeper, and the money is just a manifestation of what you are experiencing at the root cause of your business. You're not getting enough sales because you might not be reaching the right customers. You might not be making enough profit because your costs are too high. The money just shows itself up as having seen as shortfall or a windfall. So it's just a gauge. And then money is the root of all evil. Frankly, it's not. At the end of the day, I'd like to see your mindset change to this. I use money smartly to optimize results. So think about money as something that you are going to use to build your business, to make it stronger, to make it better, and to make it help you achieve the goals that you want with your business. So whether you're a nonprofit organization or a profit organization or a public sector organization, the money allows you to do what you want to do with your business. Second part, it's the fuel. So there are a number of companies that grow at extraordinary rates, particularly the smaller ones. They grow, year on year, and they get bigger and bigger. And the more they grow, the more cash flow challenges they feel. And that is because they never have enough fuel to run their business. So let's figure out how to build that fuel. And of course, money mirrors the health of our business. So I often talk to a lot of clients about their financial statements. And I say, your financial statements are your mirror to your business. So if your financial statements are not really showing health, or they're not really structured well, or they appear disorganized, or they're inaccurate, it's really a reflection of your business and what you might be doing in your business. So look at it as a mirror. And if you don't like what you're seeing in the mirror, then you can change some of your practices. And then maybe that mirror will start to show you a better picture. So that's how you need to think about money, that all it is a thing, and that it helps you grow your business. So I'd like to just do a quick survey now. So how many of you talk about money in your business? I'm looking on the side here at all your photos and your names. So how many of you talk about money openly inside your business? You can put your hands up. So Patrice, are there little gauges that they can kind of chime in and say anything? Or yes, always good. Yes.
Yeah,
are you saying
they're
good things?
They're putting in the chat.
There
They're
you
giving
say,
those
yes,
options.
would like to do this more every day. Yes, yes, it's okay to talk about money. Good, good. So you're not shamed with it, right? It's money. You need it, right? You see it. Okay, good stuff. Okay, so the first message I have for everybody is to think proactively. A lot of us think of financials as accounting, bookkeeping, back office. It's stuff that I've got to do to get to CRA. And all that accounting is it measures the past, it's objective, it records transactions, it's not really in the greatest format, and sometimes it's out of date and inaccurate. So if you're looking to that to get your decision making done, you're going to be looking at history, you're going to be looking at outdated information, and you might also be looking at meaningless information. So the first thing that I really do when I work with my clients is I say, let's restructure all this information so it makes sense for you to make decisions. Let's really understand how information flows through your business. Let's understand how money flows, and let's restructure it. And when you start doing that, you stop with that bookkeeping hat, thinking of it as bookkeeping, and you think of it more as, how am I going to use this information for decision making? And at the end of the day, you want to be a financial manager of your business. So you want to use whatever you have in terms of information and look to the future. You want to put in some subjective indices. I think I'm going to grow 5%. Well, what makes you think that? Well, everybody around me is growing at 5 or 6%. I don't see why I won't grow at 5 or 6%. Oh, financial statements. If you ever look at the statements your accountants prepare for you for tax purposes, they're just not helpful. You might find it better to reorganize those line items so you can actually understand how money flows through your business. And I'll show you an illustration a little bit later. Often what I find is 90% of the time that I'm walking into an organization, their accounting statements are upside down, and they don't know whether they're making margins properly. They don't know whether, what their fixed and their variable costs are. They can't separate it because they've just pulled out the good old QuickBooks or the good old Xero and FreshBooks and just keyed in their transactions like Xero tells them to do. But really, that's your most strategic tool, is to take that accounting package and rearrange your information so it makes sense for you. And it doesn't take long to rearrange it. A lot of these software packages, with many of them, I'll take 5 to 6 hours to fix it. It's really not hard, okay? So it rearranges the information to provide better decision making, and it's ad hoc. So if you're going to buy a new piece of equipment, there's nothing in your books that's going to tell you yes or no, but you're going to look at the equipment cost. You're going to say, how much money can I make using this piece of equipment? So that's subjective. You might look back at revenues and say, well, this is how much I made on the existing equipment, so maybe I'll do better. So you're going to bring a whole bunch of different types of information to play when you're looking at it. So, don't get stuck with your accounting statements, and recognize that you can use a whole bunch of other sources of information to make your decisions. So my next question to you, quick survey: how many of you look at your financial statements regularly? Let's say every month. How many of you look at the top line every month, revenues? How many look at profit regularly? Jason, so tell me about that. Do you want to take yourself off mute and tell me what you do? No, he doesn't want to. Oh, there he is. Okay. So only bird's eye view, income only. Okay. Okay. How many of you look at your balance sheet? How many think I'm speaking gobbledygook? Yearly. Okay. Okay. So one of the things that you have to get comfortable with is understanding how to read a financial statement and understanding how to read a balance sheet. I'm not going to cover that off in this session. Okay. There are other sessions that the BACD offers on that. There's a whole bunch of training they offer on that. And I haven't looked at it, but I'm sure it's pretty user-friendly for you and that you can use it, okay? The only comment I have to make is, don't just look at income, look at balance sheets. And I'll tell you why, and this is my banking experience coming in. So the income statement tells you how much money you've made. Great, you're making lots of profit. The balance sheet tells you what your financial health is. It tells you whether you're too heavy on debt. It tells you whether you have enough money in the business to keep it going. It gives you, it's like cash in the bank, if you will. So it tells you a lot of things. So when an outsider is looking in, is going to qualify you for a loan, or an investor is looking in, they're going to look at the balance sheet. They want to make sure you're healthy as a business, because you can look great mucking about with the profit loss stuff, but the balance sheet actually shows the ugliness. So learn how to read those statements and get your accountant at the end of the year, sit down with them and get them to explain it to you line by line. And they will explain it to you and explain what they saw and what you could work on. Really, really important for you to do at this age of your business. I don't know how long you've been in business, how many years you've been in business, but I'm presuming a lot of you are, you're not in the category that we typically visit at the BDC, which is the Business Development Bank. But I would suspect that if you're brand new to the business or you're relatively small, your accountant shoves out the information to you, sends you your CRA forms and says, okay, you're filed, now just pay some money, and doesn't take that time to explain things to you. Well, you know what? You're paying a lot of money. Ask for an hour, sit down, and get them to explain it to you. They're the best people. They've looked at it intimately. If you've got a decision you want to make, ask them. Okay, they're experts at this. Any comments? So you're new to gobbledygook. I would suggest just go through and just play around with your accounting and just have a look at how it's structured, the reports and what's going on in there. I don't know how often or how up to date you are, but try to keep them up to date because that's really important so you can do the financial management element. Okay. And now I'll go into why. Okay. So the first thing I ask all of our clients, whenever I see them, I say, what's your burn rate? And the burn rate means how much money are you spending constantly? You know, if you think of your own house, you know your mortgage payments, you know your food, you know your clothing, you know all these things. You know roughly you need how much money to spend on a day-to-day basis. So on a day-to-day basis, do you know your burn rate? So many of you will go right away to the top 3 items that make sense to you. Oh yeah, I know salaries and I know the materials I spend. Great. And I go, but what else? Did you think of fuel? Did you think of credit card fees? Did you think of digital advertising? Did you think of repair and maintenance? Did you think of office and supplies? Did you think of your telephone expenses? So there we go. The burn rate's getting bigger and bigger and bigger. Those are the surprise expenses. And there's more. Your vehicle leases, your rent, your utilities, your loan payments, your owner draws. Oh yes, owners need to earn an income. So now you see how I've told that up? $12,000 a month. This is an example. Your financial statement should be able to pop this out to you instantaneously on a monthly basis to say, how much are you burning every month? And then when you divide by 22 days, because on average, 22 working days in a month, you're burning anywhere from $500 to $600 in this example per day. So know your burn rate. This is the cash that's going out of your business constantly. Now, any thoughts? And this is where I need you to tell me. I want to see if you would know how to use this information. So if you knew that you were spending $600 a day, what else do you realize you need to do? Any ideas? If I'm spending $600 a day, I'm in a business. Maybe double each day. There you go. There you go. So now you got a guideline, right? Now you got a KPI. Hey, I've covered my burn rate. Covered my burn rate. Covered my burn rate. So you're on it. And now you know why you can track the top line only because you roughly know how much you're spending. So on some months, the burn rate goes up, some months goes down. Life is never nice and smooth and steady, is it? So when you've looked at a month, then you look at 2 months on average, then 3 months on average, and you create a rolling average. And so on average, this is what I'm spending. So on average, this is what I better be making. Because if I don't make this money, if I don't sell this money, sell this much work, I am going to be broke. It's a very simple indicator. So have any of you stopped and calculated your own burn rates? So I think that's one thing. The other thing is, I'm not just talking about expenses. I'm talking about payments that don't hit the expense line, like the loan payments and the owner draws. Sometimes they don't hit the expense line. So look at every ounce of cash that is going out. A principal payment on a vehicle, that doesn't hit your financial statements. So you want to look at all the cash going out. That's what I mean by burn rate. Okay. But yes, once you start seeing that, you can also start to see where the money is leaking heavily and it shouldn't be. And you can then start to reduce expenses. So that's the very first thing. That if you know this intuitively, you pretty well know what your KPI for the day should be in terms of sales. Any comments or questions? Ideas? Pretty easy, right?
Seems straightforward enough.
Yeah, pretty easy. Okay, so why do I care? I keep on going. You're right, this should be business or personal. And sometimes we don't know anything. I guess, right? But you're right. And you don't have to make it complicated. You know, you can always just have another expense for the small stuff, but you want to just kind of control it. Like whenever I get groceries, I know that if I've spent, well, these days it's astounding, but whenever I've spent over $200, I look at my kids, I go, what did you put in the cart? I know I should be spending $150. What did you put in the cart? Then I start to see, right? So you know that something's unusual in there, okay? Which happens when I take them every time. All right.
Alka, before you move
yes.
on, Anna asked a good question. Should be business and personal? So I know, especially in this case, as a sole proprietor, as Anna is saying, she's a solopreneur. Yeah, how would you separate that? Because it might not be a direct expense. They might actually just be able to get it as an income deduct. You know what I mean? Like,
yeah, I see you. So what you can do is you can actually, you know what, like, you know, you should keep records of your business, period. Number one, okay, always keep them separate, okay? And I know you're sharing expenses like the building, like the utilities and so on, okay? But at the end of the day, for a sole proprietor, your owner draw is to pay for all those other personal expenses, right? So that's why I would want you to put it in here, because you got to be able to make that money to keep the lights on in your own home, because that's your salary. That's your imputed salary, okay? And the owner's draw is the amount of money you're drawing out of the business to cover your personal expenses, because that's what you have to do. So, but you should always make sure that you don't meld it all into one, but rather keep some separation, okay?
There's another question. Would you take a percentage, like for your car, an example, use both for business and personal? Yeah. And I think if I'm understanding it correctly, Alka, and correct me, obviously, if I'm wrong, but how I do this, especially because a lot of our clients are sole proprietors beginning and starting out. And to Anna's question, so Anna, if I'm understanding it right, 2,000 would be owner's draw, but you could take that 2,000 and break it down. So you know that what you're pulling out of the business in order to cover those personal expenses, you can see it clearly. So yes,
you could split it out. You could split it out, like what parts business related out of your owner draw and what parts for groceries for your home.
Correct. And
so that's you can do all those things. In fact, you know, in here, there are no, this owner has already charged their vehicle and expenses directly to the business. So I'm showing it, but in most cases they're not. So if they aren't, then that owner's draw is going to obviously be bigger. Just really be realistic. Don't just put an owner's drawing because you think that's the right number to have. Put in what you've used. Look at the last two months, because that's what you need to live. So put in what you've used and be realistic, because if you're not, you're going to cut yourself short. The biggest thing is being realistic and being honest. Because if you're not, you're going to get into trouble. That's a reality. You can always, if you don't put it all on the table, you're not going to be able to cut back and figure out what to stop spending on. But if you put a fraction on, you're going to be kidding yourself. Any other comments? Would you like to take a percentage? Yeah. So I think that's the question that you're asking, Pamela, as well. Thanks, Patrice. This is exactly how I'd like you to be kind of interacting with me here and asking all these mundane questions. So in your mind, I'd like you to remember the number 560 at the bottom here. And I'll tell you why next, okay? So the next one is called Know Your Cash Conversion Cycle. So here's the reality of every business, whether you're small, medium, or large. And the cycle is more painful for the smaller ones, but they can also be painful for the bigger ones. And I'll give you some examples. So here's the reality of our businesses. The first thing is we buy inventory. Some of us do anyway. And we haven't paid for it because we might have used our credit card or the vendor has given us some payment terms. And it sits around before the first unit is sold. How long is that on average? Then, excuse me, customer comes in And in your case, it might be using a credit card, but in other cases, you might have to invoice them. So if they pay by credit card, great, you're going to get paid in 3 days. But if they don't, they might take 30 days, 40 days, 60 days to pay. So from the moment you buy your inventory, the time you finally sell and get cash, it could be a long time. Luckily, your vendor or your supplier has given you time to pay. So it reduces how much time you're waiting because you got time to pay. But at the end of the day, this is how long you have to wait to see cash come in. It's a long time for some people, particularly if they're not using Square or using kind of a credit card mechanism to pay. And this is where businesses don't take account for their burn rate. Because while they're waiting, day in, day out, $560 a day is going out. Now, you're gonna say, well, how do I measure this? Where am I gonna go? How do I do this? So you can write a note to yourself right now and Google average days on inventory in hand, average days receivables outstanding, average days to pay vendors. They're all ratios and there's ways to calculate them. And then you add them up and figure out the number. Like I said, I'm not really going to go through the formulas. I want to get you the concepts today. I want you to understand the why. The mechanics of figuring out the number is minutes away. So let me give you some funny examples now. Amazon, what do you think their cash conversion cycle is? I looked it up last night. It's negative 37 days. Negative. You know what that means? It affects people like you the most. They get the money from the customer right away. Yes. And they take 37 days to pay their vendors. That's what that means. So people who list with Amazon get paid slowly, but they've already got the money from the customers. Yes, and so they use that money to fund their business. That's where they get the cash from. Scary. Now, what do you think a construction company would be like? Like a renovator? Any ideas? The reverse, absolutely, if not double or triple. They have to wait, some of them have to wait as long as 120 days. So they're waiting 120 days to get any money because of their holdbacks, because, you know, all kinds of other issues. And their suppliers wanted money sooner because with lumber shortages and everything, oh, you got to pay cash. Sorry. Now think of the person that orders electric bikes from China. Large container load of bikes coming in. So they've paid everything. They paid 30% to the manufacturer before they filled the container. The container arrives, they got to pay 70%. They haven't even sold a bike. And now they got to sell the bikes. So knowing that cash conversion cycle is crucial because once you know how long you have to wait, you then know how much cash needs to be held in your business to keep the lights on. And this is the pain that every one of you feel. Where's that money? Any thoughts? So you want to know what this means. All right. So every business needs something called working capital. And you hear about it all the time. Where's the working capital? Where's the working capital? And working capital is your fuel. So you've got cash. Yep, that's sitting in your bank. You've got receivables. So that's money that's coming in at whatever pace it's coming in. And you've got some inventory that's holding cash. So that's your working capital. It's going to be able to convert to cash within, say, a month or 2 months or 3 months. And then you got to pay your suppliers. That's your accounts payable. So this is the calculation for working capital. Okay. So the business we talked about earlier, $560 a day, right? We look at the cash conversion cycle and we calculated 70 days. I made these numbers up, okay? Average days inventory on hand, 45 days. Average days receivables outstanding, 60 days. Average days to pay vendors, 30 days. So their cash conversion cycle is 45 plus 60 minus 30, 75 days. So will they be able to last 75 days? Do they have $42,000 in working capital in their accounting statement, in their balance sheet? So now when someone's looking at your statements, they're calculating this number, they're looking to see if you need cash or you're cash strapped or you're managing your money. It all comes together. You see that? Cool. Isn't that cool? Basics. So there are a lot of twists and turns I can take you on this one. I'm not going to. But first, let's get used to this. Right? Let's get used to this idea. Let's measure it. Let's calculate it. So QuickBooks can calculate, or FreshBooks, whatever you're using, can calculate your average days inventory on hand, your days receivable, and your AP. Calculates it just like that. And you can then do the math. You can calculate your burn rate, pull up your profit loss statement, add some of those cash transactions like owner draws and loan payments that you're making to it to get your total burn rate. And you'll see if you've got enough cash. And then if you don't, you need to start forming strategies on how to make sure you can keep this cash steady. So maybe you cut back a few expenses, maybe you stretch out a few things, and now you're managing your money smartly. Okay, instead of feast or famine, up or down, heart attack, no heart attack, all those things that go with it. Okay. So I did a survey. I ask my clients every time I do a financial management project with them, and I say, so how many of you are white knuckling it before payroll? And they look and their jaws drop. And how did you know? I said, easy guess. So my current client has a payroll of around $500,000. They pay it at the end of the month. And the 2 weeks before the end of the month are pure frantic behavior for them. So we say, you know what we're going to do? We're going to take that $500,000. We're going to divide by 4. And we're going to hive off $100,000 each week and put it in a bucket, so that we're not frantically screaming, and that we don't spend this money and we set it aside for the end of the payroll. That's the kinds of things that we start talking about building strategies around. Okay. And it's kind of important to do that. So it doesn't take long to do. You don't have to do this day in, day out, month in, month out. Just sit quietly for a day, look at your numbers, and then this is, you can start forming some strategies and tactics to do this. Any comments? Questions? Cool. I'm glad somebody said cool, because I can make accounting really boring, or I can make it interesting. So I've chosen the latter. But this is the stuff that I think is kind of fun. Okay. And I've kept it simple. So that's number 4. Know you have enough working capital. So many businesses get into trouble and they come to the business development bank, and that's because they never had enough working capital to begin with. So we offer them working capital loans. And then we show them the strategies and how to kind of keep that contained and to not rely on the loan after a while. Okay, so those are just strategies. Okay, so the next one, that's my favorite, is called calculate your markup right. So a markup is the money that, you know, the price that you're charging over and above your cost. And often we'll say, oh, I'm going to add 40% for my markup to get this price. Okay. The 2 words that are really confusing is margin and markup. They're 2 different things. Two different things. So I'll start with the explanation first on the left-hand side, and then I'll show you the calculation. And this is a simple calculation yet again. So your margin is how much profit or gross profit you make off every sale that you make. So if you sold a box of shoes and it cost you $40 to buy the shoes from a supplier, you sold a box of shoes for $100, it cost you $40, your margin would be $60. Okay, that's profit per sale. And then that $60 is used to pay all your fixed costs. Okay, very simple example. The markup is the overhead charge or the charge that you add to the cost to get to the target price. The percentage of margin is not the same as percentage of markup. Just remember that. So if you want to make a 30% margin, your markup has to be 43%. That's how the math works, unfortunately. And I'll show you on the right what happens, okay? A lot of my construction clients were saying, I add a 10% profit margin onto my costs so I can make 10% profit. And I go, wow, you added 10%? Well, really, you're going to make a 6% margin. Because that's how the math works. So let's look at the numbers here. Very simple numbers. Here's the price of a product, $10. Then you have your variable costs, salaries and wages, materials, packaging, credit card fees. All of those costs are variable. And what that means is for every unit that you sell, you're going to incur that cost. You might incur some selling cost. You might incur a commission. You might have packaging cost. You might have a credit card fee. So the real, cost of selling that product is going to be $7.50. So the profit or the gross profit that you're making on that sale is now $2.50. And $2.50 as a percentage of 10 is 25%. But when you look at the markup, which is the profit of $2.50, and you take $2.50 as a percentage of cost, it is 33% of your costs. So when you're starting to figure out what price or how much to mark up your product, you have to say, all right, I'm going to mark it up 40%. Now, if I mark it up 40%, this is going to be my price. This is my cost. Am I going to make 20% margin? You have to do the whole circle. Now, there's fancy formulas for you to calculate the right markup for a margin. I'm not going to go into that formula today. I can do that later. I'll bury you completely if I do that. But you have to go through the whole circle. So, all right, if I want to make $10, I got to mark up my product by 30% or 33%. I also know what my costs are. And when I create my profit loss statement on my accounting, I've got to separate my variable cost from my fixed cost. So I know this, okay? So a lot of my clients will confuse markup and margin. So just remember that just by adding 10% to cost to set a price doesn't mean you're going to make a 10% profit. You'll probably make a 7% profit. Go and do the math. I guarantee you I'm right. It's just worth considering, okay? Now, I know that you can't necessarily set your prices and so on, but just know that, okay? Because sometimes we do have the luxury of setting prices and adding overheads and building up our price that way. So that's the first thing. So that's number 5. And number 6 is, what's your break even? And this is how you calculate your break even. You look at your fixed costs. So those are all the other costs that you have that are fixed, that won't move. They won't increase or decrease for an extra unit of sale. So in this case, I've used an example of $10. I've divided it by $2.50 a unit, which is my contribution margin per sale. That's the profit I make on every single sale. That means I have to sell 4,000 units to break even. And once I've sold 4,000 units, it's all gravy after that. And the other way to calculate it is you can take the contribution margin percentage, which is 25%, and you'll get 40,000 in sales. You do the high math, divide by 10 based on the previous example, 4,000 units. So knowing your break even is crucial. So you got your burn rate, you got your margins, and now you have your break even rate. And you now have 3 metrics to run your business on a monthly basis without having to do a whole bunch of crazy math. You got rule of thumb. If you keep those at top of mind, ring the bell when you've hit your break even in the middle of the month, and you go, all right, anything after this is gravy. Oh, we didn't ring the bell this month. We're gonna have to scramble next month. So you can start creating those kinds of indicators for yourself, because some months are going to be good, some months are going to be bad. Any comments? Easy peasy, right? It's funny. Okay, so that's your 6th tip. So let's go on to the next one. Bill accurately and on time. Well, this is my favorite. So all of you say, yeah, I do it. I do a great job. I'm perfect. Okay, great. And this slide, you guys can go and grab yourself a coffee, and you won't have to listen to me rant and rave. Okay. I have a $15 million company that was billing 6 weeks late. Divide 15 million by 12. Multiply that by another, 50%, and that's how slow they were to collect their cash. Okay, so this is an important measure that I have to say. So first, you work at the beginning of the month, you invoice at the end of the month. Why? Invoice right after you finish your work, please. And then the customer takes 45 days to pay. So just think, if you had invoice right after you finish the work, you might have received your payment between June and July. Just think about that. Okay, so let's try to move this invoicing piece further. The number of professional services firms that have come across to me and say, oh, well, we only invoice at the end of the month. I go, really? Why don't you invoice after the work's done? Well, we're a professional services firm. So invoice after the work is done. Easy. 2 reasons. When you invoice right after the work is done, you'll get the invoice right. You won't have to guess what went right, wrong, upside down. And credit is applied for. So
yeah, what I'm
wanna
trying to
understand.
say, Alka, is what tends to happen as we first start out, especially as sole proprietors. So my sole proprietors in the house, we don't give credit. It's earned. People have to apply for it. So you have their proper documentation so they understand that in the event they don't pay on time or there's a problem, because as sole proprietors, when we first starting out, we're terrified of going, you owe me.
All right, I got that size coming next. Don't worry. Okay.
So just pointing out, credit is earned.
Yes. So you're giving them free money for basically 2.5 months, and you really want to do that with your customers? Really? Okay, so that's the first thing. Second thing is, so let's say you invoice right after the service and the customer then pays after 45 days. Now all of a sudden the cash is coming sooner. Woohoo! My cash conversion cycle comes down. But let's look at the person who gives you an incorrect invoice. Oh, customers are pretty smart. After 45 days, they dispute the invoice. And then they'll pay 45 days later after you give them a new invoice. So first of all, the dispute happened because you probably had the invoice wrong, because you did it late at the end of the month instead of right after doing the work, and have it accurate and have it well documented. So there's all kinds of noise about doing it late. So for those of you who don't have instant payment, this is kind of important. Okay, because this is the impact. I can't say enough about that. And then exactly what you said, collect the money you're owed. The number of sole proprietors who are afraid to call their customers says, you need to pay me. Shame. What a shame that is. They feel intimidated. Well, it's your money. You worked for it and you've earned it. So you just say, I have provided the service. You received the service. Do you agree? When do you think I might expect payment? And it's okay to ask for money that you've earned. Find out someone who hasn't asked you for the money that they've earned from you. The plumber, the electrician, all those people. They have no qualms about coming to you for your money. Why are you having qualms about going to your customers for the money they owe you? So it's okay. MasterCard tells you a week in advance. Your payment is going to be due in a week. Just reminding you. Just reminding you. So regular vigilance is crucial. You have to qualify your new customers. You know, there's a scam out there now where new customers are disputing their payments when they go home after they pay their vendors. And then you go through a big cycle, and the person it hurts is the small merchants. So, you know, qualify your new customers. New customers, guess what? You're brand new. I need a 50% deposit to start. Period. Whether you're a hairdresser, professional services, I just need a 50% deposit to start. If you're not willing to give me the 50% deposit, I'm going to hold until I start. It's a retainer. Disciplined collection. Just like I ask you to go and understand your financials, please look at your AR and look at stuff that's squeezing past 31, 60, 90 days, and pick up the phone or set up some mechanisms to always go and collect. And of course, have some escalation rules. Set down in your thoughts exactly what you're going to do if this happens or if other circumstances take place. Make sure that you have a process to go and collect. We had a recent situation, a colleague of mine and a client. I was doing some work with another associate firm. The client wasn't paying. He already knew that after 60 days, he was going to send it to a collection agency. And he had built that into his pricing to recognize that they're going to take a piece of the action. Because he's an entrepreneur, he's small, he had to make sure he got his money. So those things have to be in place. It's just basic housekeeping. Okay. All right. So now we're getting into, like you see, the suggestions I'm getting into are longer and longer terms. So the next one's going to throw you off your chair. I don't want to frighten you, but it's something that I live and breathe with, and I do first thing, whether you're a $10 million company or a $20 million company or a $55 million company or a $1 million company. I prefer to do it with the 1 million, so they're all easier. The 2050s are a pain in the neck, but this is what I always recommend: to do a cash flow forecast. Pull out your crystal balls. We all have them. You know, you have a best guess. You know your business better than anybody. You know the seasonality. You know what your expectations are. Pull out the cash flow. Figure out what your cash sales are going to look like. You know, plan on it. You got receivables, say like 60% are going to be paid, and you can kind of develop a little bit of a model. And then what are you going to pay out? Your salaries, your purchases, your rent, all that stuff. Then you have a net cash outflow. And then you can see that months 1 and 2, there's a shortfall. And then month 6, there's a shortfall. But you have a starting cash balance, and you can start to see what happens to this cash balance. But because you have this visibility, you now know what to expect and what to manage. None of this stuff is in your accounting system. This is you doing it on a sheet of paper with a pencil and working it out. My current client, where I'm a CFO, I do a cash burn discussion first thing Monday morning, and I do a 6-month outlook every month. And that tells the owners, stop taking money out of the bank. Very nice. Okay, so learn how to do this. Really important, especially small businesses. And yes, you do need a crystal ball. But what can you use in lieu of a crystal ball? You can use the last 6 months as a guide. You can use your plans, ambitions, and goals and aspirations as a guide, because sometimes that will drive you to get to where you want to be. But what it also will help you do is plan your resources. Okay? Really crucial. Also, the BACD, as Patrice is mentioning, has these tools and things. At the BDC, we had free tools that I built with my colleague that are there. And if you want those, I can find them for you, and I can release them too. I don't know if Teresa has them, Patrice, but we have these standard tools that we used to give out, especially with COVID. That's the first thing we asked everybody to do when the pandemic hit. We got into a webinar and said, let's talk about the cash flow forecast. Let's do it. Let's do it right now. And that's the first thing we told them to do. We didn't talk about anything else. We talked about safety protocols, health protocols, and a cash flow forecast. Very simple. Okay. And of course, sorry if this is a bit fuzzy, it's a bit light. This is a dashboard. So again, I gave you a couple of easy peasy KPIs, your burn rate, your sales break-even number, your conversion cycle. Here's the good old glossy KPI dashboard that everybody says, oh, I want a dashboard, okay? And this is a kind of an easy peasy dashboard that I've created for small businesses. And really it says, a downward arrow means bad and so on, okay? So here's some of the key indicators that people typically measure on their dashboards. They'll have profitability, gross margins, they'll have EBITDA, which is earnings before interest, depreciation, amortization, okay, and taxes. Net income is a percentage of sales. So let's see how we're doing there. Liquidity, current ratio, which is a ratio on your balance sheet. Current ratio is your current assets divided by your current liabilities. All of these things are calculations that are easy to do once you figure out what they mean, okay? And all it just says is how much can you pay your bills by? Do you have enough money to pay at least a month's worth? Leverage, your debt to equity. A banker is always going to calculate that first. They're not going to look at anything else. They're going to look at debt to equity. How leveraged are you? Productivity, days sales outstanding, days inventory on hand, days payables outstanding. There's your cash conversion cycle. You see that? It's all on a sheet. You can pump this out once a month very easily from your financial statements. It's not complicated. Does not have to be. And that really brings me to the end. We actually did take about an hour on this, which is quite astounding, which is good. So I'll go back. Here are the 10 tips. Think proactively, forward, not backwards. So mulling over past year's financial statements and crying over them, think forward, please. Know your burn rate. Know your cash conversion cycle. Use that to figure out whether you've got enough working capital, the money to fuel your business. Calculate your markups right. Know your break even, because then you know exactly when to ring that bell. Bill accurately and on time, because that'll speed up cash. Collect the money you owed. You've got the courage, you've got the passion, you've got the desire, you can do it. And of course, housekeeping, maintain your cash flow, so you're always thinking 6 months in advance. And use your dashboard just like you would a GPS as you're driving from here to Kingston, to make sure you're steering in the right direction. And that's all I've got. I don't have an hour and a half. I just have an hour by the looks of it. Does anybody have any questions or comments they'd like to ask?
Well, Alka, what I would ask, if anybody has any questions, this would be a good time. Otherwise, I would say to close it up and then I will stop recording and then we can open it up.
Okay,
People may be more comfortable. So just want to take a moment, if you could put on the last slide for us, sure, please. Yes, to again thank the 2022 sponsors and collaboration partners for our 10th annual Do It in Durham, which was awesome 45 events this year. Again, remind everybody that there's still time to register for other workshops and events. Some of them are in person, but please check your ticket. Most of them are online, and you want to be sure you've got the Zoom link, or check your email address that is correct. Check your spam folder because it could land in there. Really, really appreciate what you shared today. I'm not seeing any questions, Alka, but I want to say thank you. I know that a lot of what you covered today is things that come up with our clients. For many of them, they're in that initial year, so they don't have the data to help convert some of those formulas and things. But to your point, as it grows, it's so important to collect it and use it, because it helps with the decision making as you move forward. And I appreciate the fact that there are templates and formulas available to make it even easier to calculate and move forward from.
So if you want, you can close it off. I can give them some tips on I know they're just starting out, or they're just starting to build their businesses. The one piece of advice I really have is around, when you set up your accounting package, get an expert in to help you set it up right to marry a business model, because then all this other stuff will follow nicely. And then just stay on top of your books. Don't think it's just paperwork. Just stay on top of the books, because then you can start doing these things and driving your business. You're going to maintain your car, right? When you want to drive somewhere, you're going to maintain your business. And this is one of the maintenance pieces.